there somebody who is going to help with the money? Thank you. Thank you so much.
Lady from AIB. I want to know, do you actually support things like venture capital and private equity in your financing? That's better. And secondly, Wilbert, we've been in this economy for a long time. Is it not still, do you not still feel that it is because it is being perceived as a cash economy that we are having a lot of these constraints? Because the risk profile will be high if you're basically looking at it from a cash point of view. Because when you look at our neighbors, Kenya, there's risk, but they manage the economy far better. And I think if we change the perception, we should be able to actually give credit, and risk would always be there, but it could be managed.
Okay, so we'll take about 5. Next. Yep.
Hello, my name is Joel Basoga. I'm a lawyer. I'm from Q Africa. My question is directed to...
Patricia.
Yes. It relates to there's a booming oil and gas sector, as we've been led to believe. I think the key investment decision will be made soon. I just wonder what facilities are available for the support services sector in the oil and gas. Yeah.
Okay, behind you.
Lazarus is my name. I represent the real estate sector in Uganda. Those are developers. I'm glad to hear that you're lending the biggest percentage to the construction sector. I think in the plenary we learned that we have a housing deficit of over 2.1 million, and with a growth rate of 3.2, I'm just wondering, Wilbrod, whether the association is considering maybe having a special line of credit that can be given to the developers to solve the housing deficit in this country.
Next, right there.
Thank you. My name is Matthias. I work with Startup Africa. We engage in early stage entrepreneurship promotion with 10 universities across the country. And I'm wondering, especially for the gentleman for Finker and maybe also UDB, because women entrepreneurship was mentioned, what are some of the solutions? Because we see a lot of need for very small ticket sizes, but more patient money, which really limits these early stage, but actually growth potential startups. What are the lines of thought around that?
Okay, so maybe we can take, those are, what you have one question?
Just a simple one,
all right.
Maybe it will board. Over the years, our interest rates have remained high. And I don't know why. Maybe you have a reason why they are so high. And I think it's one of the deterrents to economic development in the country. Maybe you can give us a reason why over the years they have remained high. Thank you.
You want to start? Okay.
All right. Thank you very much. I think the first question was around the cash economy. And I agree with you. A big portion of money is not digital. It is still out there in cash form. And until all this makes its way to a regulated, organized framework, and you mobilize sufficient deposits to then make available to lend, it is a challenge. So part of our work should be to make sure we mobilize, we mop all this up so that it's actually in the financial system where macroeconomic policy can best be administered. And it will obviously translate into cheaper credit. Yes, to a very big extent, Kenya has digitized. They have had a revolution and leapfrogged many economies. And they do many things digitally, meaning money is sitting somewhere where it can be recorded, it can be seen, its flows can be tracked. So I think all of us should put our hands together in digitizing the economy and have this cash lying out there into the formal financial system. And that's one. Two, that goes hand in hand with other forms of discipline, fiscal and macroeconomic or monetary, so that these things work hand in hand to bring the overall cost of credit down. But banking penetration is key to this, and I think all our efforts to increase the number of people who bank, who are in formal financial systems, is the key to this. The second question was the line of credit for the housing deficit. Yes, the population is growing. The issue of affordability of those houses is very important. We have seen a number of private companies, real estate companies coming up, and they struggle. Even when we lend them, it's not just the building cost. If you buy a huge chunk of land this side of town, and it is remote, beyond the house, you have to construct a road that goes there. You have to arrange for water for all those houses and a couple of other utilities. So indeed, yes, developers have struggled, and some of the facilities we lend them struggle, not because they didn't even finish building, but because eventually the house is very expensive, and therefore our middle income people cannot afford it. And so one of the things we are doing, we've just had last week, we are continuing to have some discussions with the World Bank. They are thinking of arranging a mortgage refinance, Uganda mortgage refinance company, so that, one, they provide the much needed liquidity to banks, and banks can then resell the mortgages to it. But what that does, it increases the supply of money, that's on the one side. However, we've told the World Bank that we also have to assist developers, because sometimes perhaps the institutions meant to help on the basic infrastructure like roads, utilities are slow. And that increases the cost of the house if a developer puts his money to do that. So we must address those things in totality. So the answer is yes. The industry is working with the Central Bank and the World Bank to put a framework that not just addresses the cost, the tenure, but the other underlying risks of developing real estate that are sometimes not seen, like roads and the infrastructure around real estate. The third question is the question we talk about high interest rates. As I said, we concede that interest rates are not where they should be to drive growth across the economy. And that's why I talked about a combination of things that we are doing across the industry, those that are within our hands, those that need to be addressed with the government. We have put them across as drivers of high interest rates. We are trying to do as much as possible to manage our own overheads, and that's why we are sharing more and more infrastructure, try and mobilize more deposits, try and manage efficiency, but we can't do it alone. We cannot. The banking sector alone cannot do it. Governor, at every monthly meeting, he literally has a list of every CEO. You, this month, how much are you reducing interest rate? What about you? What about you? And it goes around the table. And it's such a painful process when we sometimes know that for as long as government will borrow at a certain interest rate, I will sit and lend government. The bigger part of the liquidity is in treasury bills and bonds. It's not rocket science to do this. So together, as economists, as policymakers, we must address the problem alone, together, not alone. We have a part to play as banks. The other players also have parts to play, and together we can actually bring down interest rates in the economy with the discipline required around it. Thank you very much.
Maybe since I'm the chair, I can ask you one question. My question, and I think you've talked about crowding out, right? If your business is licensed as a bank, okay, what is your policy for your membership in terms of the percentage of assets that should be in loans? Am I a bank if, for example, less than 80% of my assets are loans? How can you assist there? Because I think there must be some intervention to ensure that if we license you as a bank, at least 40, at least we can even start with 40% of your assets should be in loans?
Okay, there are a couple of ratios that the central bank uses to measure performance. Typically, a loan to deposit ratio of anywhere between 60 to 70 is good. Sometimes it can even allow a bank to go as high as 80% if it wants to push lending. But there are always costs and KPIs or benchmarks required. We have to reserve a certain amount of money and make it available all the time should a depositor want their money. There are also cash liquidity ratios in different currencies that we have to maintain, and we can never trade on that one. It is just idle cash seated across. But 60-70% is a normal range that we operate with. However, even within the regulation, there are, beyond those cash ratios, there are many other ratios that the central bank would require. They look at how much you are lending, what is the exposure on each of the sector, how much are you lending one single person as opposed to a lot more people, in which currencies are you lending so that there's no mismatch of currencies and things like that. So in there are a lot other KPIs that limit. Of course, these are control purposes for financial sector stability. But a typical LD ratio, loan to deposit, is about anywhere between 60 to 70%.
Okay, thank you. I'll respond quickly to two questions. One of them was what interventions or solutions we have in oil and gas. I think one time I was asked what we are doing and why we are not playing, in the oil and gas sector significantly, and my response was it's because everyone else is there. So I have to kind of keep where there is no one, so to say. But I think having said that, we try to support the sector, but you realize that this is a relatively new sector here, and I think a lot of people went in, speculatively, not only the businesses, but also the banks, for example. And also, I think a lot of investments in the sector are being driven, by government, so, through like public, finance. However, since in relation to our mandate of how do we support our people, Ugandans or investors or any other investors with what they need, we have a policy around local content. How do we support the local, entrepreneurs to drive enterprise across key sectors? So in that case, would be supporting the sector as well. For example, if a local contractor got a contract to maybe do oil roads, then we'd be able to support that contractor with the equipment that they need to be able to deliver on that contract. Or if you need to put in place some services, again, targeted towards the sector, would be able to support that. So currently, that is the direction that we are looking into as far as the sector is concerned. But as the sector, grows, we'll be able to review what else we can do. It's not casting stone that we are not there yet, but it's because of the way the sector has been structured since it got active. Then on the very small ticket sizes and long term, I mentioned earlier that there is a new definition in this country of SMEs. And what we realized as well is going by the old definition, I would comfortably say, we're supporting SMEs almost 100%. But going by the new definition, it makes us realize that there is this segment that we probably, a bit of them that we have probably not even been looking at, especially the micro and small. Like now the new definition of micro is up to 10 million in assets. Now those are really small. It can be up to from whatever up to 10 million, and then small enterprises is up to 100 million. And I think in the bank we used to say we'll not do anything less than 100, unless if there are special programs, like there is one we have that will probably require that for every single borrower should not benefit more than a certain threshold. So we've been managing them, under that kind of umbrella arrangement. But in terms of your question, as in what are the solutions, what is the thinking around this? Now we realize that SMEs are the engine of growth. There are very many people, especially if we talk about youth employment. We have issues things or challenges around people that finish, school and they're unemployed. And there's a lot of entrepreneurial activity in this country. So how do you use that as an opportunity to support, these kind of people to be able to do or generate some enterprise that can, help them, improve their quality of life. So we're thinking about, like I've said, this is something, we're taking now a new look because we have a new definition. So how do we get in? But having said that, we've interacted with a number of these, and the usual issues remain. I mean, even when you're offering a product, if you're a bank, you need to manage your risk. It is not something that we can do on our own. There are lots of partners, and I'm happy to note that there are very many people who are realizing this, even development partners, and there are lots of conversations around how can we work together to provide a solution, to de-risk, to ensure that we can support, these kind of people. So I think the conversations are there and the commitment is there because we realize that this is a very key and important segment of the country, especially if we're talking about growing the economy and creating jobs. We can't ignore it.
Thank you. Patricia? Catherine?
Yeah, thank you. I think maybe on this question of the smaller ticket, I mean, that's a question that's very often put forward to us, and the startups and all that. I mean, and this is more food for thought than an institutional position, because having been in the region for a couple of years now, this is an observation I've made, that there is indeed a missing gap there, and that somehow, in my view, should be addressed. Patricia alluded to it. There are two elements. First of all, build the financial literacy through technical assistance, capacity building program, and actually all the lending that we are doing in the region, including in Uganda, is associated with a fairly substantive technical assistance program, running capacity building not only for the financial institution but also for the final beneficiaries, small entrepreneurs. We even did here in Uganda a big program with Centenary Bank, training refugees, giving them financial literacy. So that's very important. And that brings me to the issue of blended finance, because we do need to combine our forces, if I may say. And we're doing something in Kenya together with the European Union in the agri-sector, where there is a big package of grant money that's actually supporting value chains. And then we come at the end with lines of credit. My own take is that, and that's a very difficult compromise to achieve, because we all have targets. We need to get the money out. Let's be very blunt and clear about that, including institutions like us and the EU. We all have to do that. But designing program that would be targeting these smaller tickets, that means you get the money out of less quicker. But I think in my view, that's what we really need to look into, such schemes where you mix grants and loans, and then you really have a mechanism whereby you can go to the smaller one. And then venture capital and impact funding. I mean, even if the attrition rate is really high, but still, I think that can really do miracle in terms of helping these startups get to the first step, be sufficiently mature. And we've seen in the region, I mean, we Delight, you all know Delight, because I think they are here with their little lanterns and all that. They were supported by an impact investor to start with. 2 years ago, we gave them a $25 million loan. And now they've been raising funds on the international capital market. So I think that there are not many of these because the mortality rate is very high, but still, for those who can make it, we should give them a chance to make it. Thank you.
Yeah. Thank you, James. Yeah. Sure.
Thank you very much. The advantage of being last in the line is you just get to compliment. Let me compliment on two questions. First, from the gentleman at the far end. Yes, I agree that blended finance is the way to go for those early stage organizations that need patient capital. And normally for us as financiers, if we have that kind of partnership, then we are able to come in and support them through some kind of phased financing over that period to avoid actually risking all that capital at the beginning. And we've seen successes in that. But also I want to mention that we have financed entities that have actually started the journey and have succeeded quite impressively. And normally what we find is that as they scale, then they lack the capacity of actually running large organizations. They start to need certifications from government agencies. And normally as a financer, we are looking for partnerships and agencies that can support upskill these entrepreneurs to move to that next level of running a professional business. And if you don't do that early, then again, it will collapse. So there is a mix at both ends of the journey. I want to agree with the first question, the gentleman, the issue of cash affecting pricing as well. Yes, as you get the market mature and become more digitized, then we hope, and there's proven cases that you actually will see reduced cost of financing. I want to state that in this country, in Uganda, over the time we've seen actually interest rates reduce, but not so much. Obviously, with the introduction of information sharing through the Bureau, we're getting better profiles of the people we finance. Even as organizations mature, it's most likely that I'll give a concessional price to a customer that has been borrowing recurringly than a new customer. And we see that continuously reduce the cost of funding in the industry. But as Wilbrod mentioned, the major impact is going to come through those structural changes because if we are only dealing with cost of doing business and and data, we are only playing with that small margin that the bank has to deal with. The bulk of the issue of price really will come from the cost of capital at the end of the day. Thank you very much.
Just an observation, okay?
Hi, my name is Franklin Bugep. The gentleman spoke about oil and gas, why the UDB is not, what UDB does in the area. I just wanted to specify that I realize there's a little misconception of what oil and gas is. Oil and gas is not just the drilling. The mandate of UDB covers financing development in agriculture, housing, commerce, and you name it, which means they are already supporting the industry. We might not call it oil and gas, but all the supporting industry that make the drilling possible is part of, that particular sector. That's the little observation I wanted to make.
Okay. I think in the interest of time, are you itching to say? Okay.
Patricia, I know the mandate of, as you said, the mandate of the development bank actually it's widespread in terms of promoting or pushing development in this country. But oil and gas is a totally new area where a lot of skills we do not have. What I'm thinking, or what has happened in other countries, you try to partner with these so-called SMEs to get them the right skills, such that you develop, you give them capacity, and after a while, you are able to win them. They're able to actually succeed and make money. And the multiplier effect will be seen. But without that partnership, commercial banks have got a very different mandate, just like people said. I mean, the shareholder wants banks and insurance company are not made to make losses. I know that. At the end of the year, you have to declare dividend. But yours is long term. And you really, for a new area like that, for a new area like oil and gas, we need to support it. Mining, for that matter. They're very useful. And I've seen cases where it has been a win-win. If you're really ready to, some of them the gestation period is long, some of them it's acceptable, it's medium, but we have to take the distance.
Thank you. It's a comment. Yeah. I think it's a comment, and it is well appreciated. Thank you very much. So, in the interest of time, we are now at 4:45. We're supposed to be back at 4:30. So, I think this is the time to wrap up. We should thank our panelists. I think this has been very insightful, short and sweet, right? Thank you so much. Thank you. And all of you, thank you so much. Thank you. Yeah, I'll send you an email, yeah. Yeah.
The moderator?
Yes, sir.
Thank you.
Thank you. That's your credit? Okay.
Yes.
Solid block.
We do capacity building, which means that I was itching to tell the gentleman that a lot has been done here in terms of capacity building.
Okay. Thank you, sir. Very good comments, yeah. Yeah. Yeah.
I would like to have your card. So my name is Joel, and next time I will sit and say, I was trying to come and pick up the phone. They might not believe me.
No, they will just
Okay, I can discuss. Yeah, wait.
okay, but I can drop you.
Please. Because there's something that I wanted to.
I'll drop you. Yeah?
Don't mix it with all that. Yes.
We are interested in housing. As for excellent, yes. Okay, thank you. Right.
Let me leave you here.
I will have a look. Yes, thanks. I wanted to give you mine as well. Thanks a lot. Thanks for your kind words. We're doing our best. I know we've done a lot actually in Uganda. Yeah, so very good. Oh, and if there is anything we could do better,
I'll shoot you an email.
good, thanks.
Good.
Yes, sir.
I'll give you my card already, and I'll take you yours. Yeah, so I would need to, look at this, and then, I'm based in Nairobi. Well, I'm going back tomorrow, so I'm coming back.
I know what you're talking about. You know, I can't comment on members. On member issues. Yes, I know.
Well, I mean, it's just, the counterpart to see.
I know.
But that's why I want to have a look. Thank you so much.
Just